August 28th, the last Friday in August. It's football season. I'll try to stay focused on economics, but it's football. Say goodbye to the wife and family till February. The scene, financial scene, as much as it was last week, the outside world ex-US is a mess. I mean, a real mess. And the most disturbing part of the mess is that China provides no accurate data. So we don't know where they are as a policy matter, what they're trying to do. We don't know where they are as an economic matter. All of the stats are phony. And it's the world's second largest economy, and the rest of us are flying blind. Meanwhile, the U.S. economy, I've been a grump and a skeptic going all the way back to 2008, but the data pattern unfolding now is, it's disturbingly like normal. The housing market is in a gradual recovery. The number of sales are catching up from the pit. Real estate prices are rising, but not at a slope that would scare anybody. There isn't any part of the U.S. economy that's overheating, except maybe car loans and student loans, but they don't amount to much. The economy's growing. We got a big 3.7% revision for the second quarter, but first half of the year is 2.2%. The third quarter is going to come in a little under that, but it's about where we are. A little more than 2% growth, and at that level, there is no reason for the Fed to stay as emergency easy as it is. Now, its first step, going back almost 2 years, was to begin to taper quantitative easings, which led to the taper tantrum and a sudden jump in interest rates, which unwound completely last year. And the Fed stopped buying securities, stopped QE more than a year ago. But now the overnight cost of money is still pegged at zero, which couldn't be more artificial. The Fed needs to get off zero, and the only things really holding it back are the mismatch in the job market, in which we have very low unemployment but incomes are not rising, and the big deal, which is overseas. What impact would a Fed rate hike have on the rest of the world, on uncertain markets and so on? And my hunch is not enough to worry about. Wouldn't surprise me in the slightest if the Fed came off of zero in September, if only to get it over with. Now, next Friday, September 3, we're going to get the newest labor stats in terms of job increases and incomes, and it ought to be okay. There shouldn't be trouble in it. Maybe the Fed holds off, but I'd rather they didn't. Mortgage land, most important for us, the Fed owns $4.5 trillion worth of treasuries and mortgage-backed securities, which it is rolling over every day. If you refinanced your house this summer and your loan paid off, there was about one chance in 3 that the Fed owned it, and when you paid it off, the Fed went out and bought another one. It might have even bought the loan that you got when you refinanced. And so I think mortgage rates stay down unless and until there's some sign of actual inflation, even though the Fed begins to push up on the short-term cost of money. I may be accused of drowning in Kool-Aid that's left over from my feelings about my football teams, but sometimes that's just how it is. Have a good weekend.